Tesla has been down of over 60% during the last year, but will we see a genius trick from Elon Musk during the next couple of years? Or has the Twitter takeover has been a massive mistake? Well, today you'll find if Tesla stock is a great stock or not to buy at the moment. So I'll share with you my full stock analysis on Tesla stock, and I'll start as always by checking out what is the business model of the company. So how are they able to generate their income and who are their different customers? Afterwards, I'll make a fundamental analysis on this company followed by a price prediction for this business to see if it is currently under or overvalued. Tesla is an American multinational created in 2003 by the infamous Elon Musk that is mainly focusing in the automotive field and the green renewable energy. This company that had some modest start has been shut to the eyes of the public during the pandemic in 2020. In fact, between 2020 and 2022, we've seen that this company has been growing pretty rapidly. And now Tesla currently worth slightly over $350 billion. In 2021, Tesla has made slightly over $53 billion of revenue from three main branches, which are the sales and services, the automotive leasing, and the energy generation and the storage leasing. But in fact, we could say that the biggest part of their revenue came from their different sales and services, which actually account for over 96% of their total revenue. And the biggest part of it came obviously from their different sale of their cars that are ranging between $50,000 to more than $150,000 per car. You notably have the Tesla Model X, the Tesla Model Y, and the Tesla Model 3. But another big part of their revenue came from the infrastructure, notably to charge those cars. And one of the non-car products that Tesla has been selling since 2015 and that should see some potential exponential growth over the next couple of years is called the Powerwall. In fact, this solar energy system could help in the near future many different businesses and homes to store more energy. One of the main things that differentiate Tesla with their other competitors is their supply chain combined with their customer experience. Indeed, they have a pretty special way to get their products and to build them and also to be able to sell their different products to their customers. First, to be able to construct the numerous cars that they have been able to sell over the last years, they have many hundred of different suppliers all around the world that are giving them the pieces needed for the different cars. And an interesting fact about Tesla is that to avoid an eventual shortage of pieces for their cars, well, they always make sure to stay over a certain safety threshold. And for the sales of their different products, instead of using the good old franchise dealerships, Tesla is going for direct sales and services. So they are selling straight to their different customers instead of passing through different franchises. And Tesla believe that by doing that, this helped them to increase their production development while offering some better customer buyer experience. And with the numerous incentives from the government to buy different electric vehicles, this has massively helped Tesla to increase their total sales over the last 10 years. However, it has took a lot of time for them to become profitable with this business. We've also seen recently that there was an increase in the total infrastructure for the different electric vehicles. However, we're still very far from what would be required for everyone to have their electric vehicles, notably with the new Canadian government requirement that has said that there will be no new gas car that will be sold after 2035 in the province and in the whole country. So as you can see, as being the number one company in the electric vehicle sector, Tesla currently has a great position on that side. But often when we are talking about Tesla, we are more talking about its extravagant owner Elon Musk than the company itself. Indeed, this happened because in the past we've seen that Elon Musk has been able of the best as well as the worst. And more recently, one of the main things that has made Tesla stock crash is the acquisition from Musk of Twitter for about $44 billion. And despite using a strategy of leverage buyout to buy this new company, which means that Elon Musk will use a lot of borrowed money to make this acquisition instead of its own cash, well, this has made the investor pretty nervous with this news. And obviously, it has been reflected in the valuation of Tesla. In fact, what can be very frightening for the different Tesla shareholders is that Elon Musk is currently invested and has some pretty important position in more than 5 big companies. Obviously, you have Tesla, SpaceX, Neuralink, The Boring Company, and more recently, Twitter. And in fact, having too much companies to manage could actually affect the quality of its management. Plus, Elon Musk is someone that is pretty much very volatile, so you never know what he's gonna do next. For example, recently he has made a poll on Twitter to see if he was gonna stay as the CEO of Twitter or was he gonna resign. And the results were pretty clear that he should resign as the Twitter CEO. So it's still unsure what he's gonna do next, notably knowing the fact that he hasn't found yet a replacement for him to become the next Twitter CEO. But in any case, those different actions and distractions that are coming from the acquisition of Twitter hasn't really helped the case of Tesla. In fact, when you combine that with the raise of the interest rates as well as the high inflation, this hasn't helped this company, which has lost over 35% of its value over the last month. And as I told you earlier, over the last year, it has lost over 65% of its total value. But now, let's see if it could be a great entry point for you to buy this company. As you can see in valuation terms, this company currently worth a whopping $388 billion. However, with a quite high price to earning ratio of about 38, which means that on that side, this stock would be currently overvalued. After, you can see that their profit as well as their operating margin are pretty fair, and they've had over the last 12 months some great 32% of return on equity. And over 2022, we can see that they have been able to generate about $75 billion of revenue. But what is crazy is their quarterly revenue growth of about 56% year over year, as well as more than 100% of quarterly earnings growth. And a good thing for this company, especially with those high inflationary times, is that they currently have a lot more debt, about 20 billion, compared to what is their debt of about $6 billion. However, for the risk of this company represented by the beta on a 5 years period, you can see that this company is way more volatile compared to the average market with a beta of about 2, which is pretty well represented by its 52 weeks change of about less 68%. But over the last 4 years, we can see that their total revenue have been massively increasing, which has obviously led to a massive explosion in their earnings before interest and taxes. And since they've been able also to increase the sales of their vehicles and their products, we can see that it has been massively reflected in the operating cash flow that have been growing pretty fast over the last 4 years, which has provided them a great increase as well in their free cash flow. Now, to see what should be the real value of this company, I'll be using many different evaluation models, starting with the Peter Lynch valuation model first, which is a basic formula using the future growth of the earnings per share plus the dividend yield that you come divided by the price to earning ratio. And with these information, knowing that this company isn't giving any dividend, you can see that the results is that it is currently fairly valued. But if Tesla started to give a dividend, we could see that it would most likely be undervalued or way undervalued at the moment. Unfortunately, since they are not giving any dividend, the dividend discounted model won't work in that case. And to finish, we'll check out the real value with the discounted cash flow model, as always starting by calculating what is the cost of debt followed by the cost of equity, and after you find the cost of debt and equity to find your weighted average cost of capital. After, we'll basically use our free cash flow with the potential perpetual growth rate to find what is the enterprise value, and we'll add all the different criteria over here, and in that case we can see that its intrinsic value would be about $43 at the moment, which would mean that this stock would currently be overvalued with a current price of about $113 per share. As you can see, depending on which valuation methods are you using with also the fundamental analysis, we can see that the results were pretty mixed. However, historically, Tesla hasn't been the company that had the best financial metrics, as we can see with its IP ratio that was over 600 during the pandemic, but it hasn't stopped them from being one of the best performing companies during that period. In fact, this is a company that has a massive valuation because of the potential that it has, with the project growth over the next couple of years in the green renewable sector as well as the electric vehicle sector. Well, it could be one of the best long-term holdings that you could have in your portfolio. But once again, this is only my personal opinion and it's not a financial advice that I'm giving to you. However, if on your side you want to see if the e-commerce sector has a brighter future compared to the electric vehicle sector, well, you can check out the video that's going to be right over here, which is going to be a Shopify stock analysis, and I will see you soon. Peace!